Hey guys, it's Chris Knighton, and I want to take this minute. I'm trying not to make this too long because I tend to not overanalyze, but I analyze it on a deep level on a bunch of different factors of what's going on in the market to help myself understand, and then also help our clients understand. So if you clicked on this, this is just my viewpoint on what's happening, and each person out there. Really, what I suggest to everyone is if you're concerned or want to know more about what's happening in the market and how that affects you, definitely speak to us, speak to a mortgage broker, speak to a professional that's going to guide you in an unbiased way, because understanding your own personal financial situation is by far the most important thing that you can do, because understanding the difference between variable, adjustable, fixed rate mortgages, and what you have and what you're currently locked into, if you do own a home and you have a mortgage on it, understanding what you have and how the interest rate increases have affected you is incredibly big. Because I was talking to a gentleman today where he was saying, well, my variable rate mortgage, it's gone up 1%. That means I'm going to have to pay an extra $500 a month. I can't afford it. And I said, well, it's a static payment. Once we looked into what his mortgage actually was, it's a static payment variable mortgage, meaning that his payment is the same every single month. The only difference is when that interest rate goes up, more of his payment will be going into interest than into the principal. So there's a lot to unpack there. If you have any questions about that, please let me know. But just to go over a few graphs for you, so to see what we're looking at, you can't find this anywhere on out there, because we track this every single week internally, and then we utilize these data points to show people what's actually going on. So first thing, what's happened in the last 10 years in the Ontario real estate market? Specifically, we're going to look at the Golden Horseshoe in Niagara. We can pull this for anything, but specifically in the areas that we typically do our business, which is, Halton, Hamilton, and Niagara. Basically, the whole Golden Horseshoe, including Niagara. So what I want to bring everybody's attention to first is where we came from. And when we're sitting down doing a listing presentation and talking about pricing, which we can get into in a little bit, pricing is the most important thing, especially in a downwards trending market. When I say downwards trending, it's not a bad thing always. Yes, you could have sold at a higher point back here in February, but you might have been also buying in that same market. You can never 100% accuracy predict what's going on in the market. So understand that there's always going to be opportunities for the right people at the right time. Looking back at 2017, we saw this massive peak spike here. Now, this was mostly due to not decent interest rates. If you're looking over here on the interest rate side, they kept it the same for multiple years, and it was working great until there was a supply and demand issue. That's what this was, a basic supply and demand issue. So we saw this peak in 2017, multiple offers, people going over asking price, and then we saw what was the new mortgage rules. They were doing stress tests, and what they did was gradually increase that interest rate. Now we saw about a 15 to 20% decrease on average, which I don't know if people remember. It's funny how quickly people forget things when it comes to the market. However, we saw this big spike, big run up, but then it also came back down. And what happened over the next 2 years was between middle of 2017, was May 2017 to the beginning of 2020. We saw a very steady market. Your traditional, on average, if you put a trend line here, 5 to 7% increase on your single family home asset, or if a townhome, whatever it is, your principal residence. So they did a great job. When I say they, the Bank of Canada did a great job on increasing those rates gradually, so we saw a realistic trend line over that 2 years. Then what happened in 2020, they went and plummeted the interest rates. The overnight was basically zero, was nil. And we had, I know I have clients that got 1.5% interest rates for 5-year fixed term. Incredible. It's almost unreal. It's basically free money. Now they did that to ward off what everybody thought was going to happen from COVID. And we saw this spike down because nobody did anything in April. So you see this massive spike. We went from 691 down to 635, basically overnight. So we saw about a 10% decrease overnight. But then what happened was, not that people didn't care about COVID, but it didn't stop consumer spending on homes. And we saw the buy up. Again, new home sales the first-time home buyers are the catalyst behind an increasing market, regardless of what's happening, because those are introducing new buyers into a pool of supply. We had a lack of supply with a lot of buyers with the ability with this low interest rate to be able to jack those prices up. Now, this is just my opinion, but keeping the interest rate at this level for 2 years during a pandemic when we were seeing historically high increases, in my personal opinion, was the wrong move. They should have adjusted and been more proactive. However, they were not. This was very concerning when we saw this for a long time, because you knew this was going to happen, and we could see this happening as well. Why they didn't, there's different conspiracy theories. We can get into a whole bunch of different things, but I truly believe that they didn't have an advisory board with boots on the ground. They still don't, of what's actually happening out there. So is it a misstep by the powers that be that are making these decisions? Maybe, but we can't change that. We can only interpret and understand where we're going. So we saw them keep this rate incredibly low, which we saw these massive spikes. We saw a 45% increase on average, 45% increase on home values in a 2-year period. Stupid. Should never happen that way. Not for an asset that does not make you any money. For single or for your principal residence, it should never be increasing that much, unless there's external factors like incredibly low interest rates and the supply and demand issue, both bumping that those prices up. Again, back here, this is just supply and demand. This is both supply and demand, low supply to high demand, with the ability of cheap money and people being able to purchase more, and this feverishness in the market. Going back to this too, if you bought in 2017, I had some clients that were really freaked out. Oh my God, I overpaid. I said, how long are you planning to stay there? Well, we're not moving for at least 10 years. Well, we're not even 10 years out yet. Even if the market goes down more, which it will, you're still in a great position. You don't wait to buy real estate, you buy real estate and wait. Great saying. So it doesn't really matter as long as you're making the best decision and you know where your know what your financial picture looks like. So the one thing I do worry about is people that did overspend and over leveraged. They are going to be in maybe a predicament, but that was the case based on actions those particular people have made. So looking at where we're going in terms of the price, this last data point in July, we're only halfway through, but we've seen a kind of steady decrease going down. So understanding we have this trend line of it was going up, but now we're decreasing. So this is kind of what's happening. Understanding that there is still opportunities to both sell and buy, depending on what your goals are. Just selling at the height of the market to cash out and sit on the sidelines, probably not the best idea right now. But if you are looking to sell in the next 5 years, because I do believe it's going to take about 5 years to rebound from where it was before, much like this was 2 years, we've seen this bigger increase. It's going to take about 5 years, in my personal opinion, to rebound. If you are looking to sell in the next 3 years, I would say now would be the best time, because you're going to see continued downwards pressure and then potential recession territory, which would then cause the Bank of Canada, the powers that be, to start having some quantitative easing. This is quantitative tightening. When you see this interest rate go up, quantitative easing with the interest rate going down. So all that being said, when it comes to pricing a property, this is one of the most fascinating things when dealing with sellers. And we've turned down several listings over the last few weeks. We've actually lost out on some listings because we weren't willing to price back in February numbers. We have a lot of potential clients that they still want to get back. They want the numbers that were back in February, where we were getting, look at this, over 120% list price to sales price ratio on average. Absolutely insane. This should never happen. The biggest determinant of that, again, is your interest rates being so low. Now, what we're looking at here is you're looking at your average price. We've seen it come down just like up here, but what we're looking at here is list price to sales price ratio. On average, over the last few years, you're rating around that 100 mark. And again, during this time of the 2 years between 2017 2020, it was tougher to sell a home, but it was more realistic what I was used to 20 years ago when I got back in this market, went into this business. So you saw the average, you're in and around that 100 or 97 to 100% list price to sales price ratio on average. And then we saw, again, right here with the interest rates the way they were. We saw this spike up, list price to sales price ratio, which was again driving the price up. We saw a little bit of a dip here towards the middle end of last year. And then January of this year, with an absolute lack of supply and feverish demand from buyers that were trying to take advantage of this cheap money, we saw this spike. I personally saw it finish. The end of the heat was February 23rd, 2022, with this particular listing that we had. It sold over asking price, but the buyer perception and the way that the buyers were handling multiple offers was changing. We saw that, and like clockwork, we told the team, you're going to see this kind of craziness come to an end. And yes, you still saw multiple offers. You still see multiple offers from time to time. But if you're looking at what's actually happening, you're looking at your list price to sales price ratio is down around 97, 98%. Understanding that you have much more competition, and the downwards pressure isn't just on the interest rates that are going up. It's also on, again, supply and demand, which kind of runs every market. If you've taken any basic economics course, instead of being demand up here and supply down here, that delta is pushing prices up. Now we have supply up here with demand being lower, or availability of that money for them to be able to purchase. We're now seeing that downwards pressure right here. And the last thing I'm going to show you, I love making graphs. However, I'm going to go just, we can take Hamilton, Burlington, but let's take, this is a good example. So let's just take Hamilton first and foremost. This is active listings versus sold listings, supply and demand. This is your actual supply and demand every single week. We track this, nobody else does. So this is the data that we have. It's directly from our board numbers that you won't find anywhere else. Just we track it every single week. So if you're looking at the difference between listings 208 to, let's see down here, 84, we were having such small weeks of inventory, meaning weeks of inventory, if you ever hear me talk about that, is if let me go over here, let's say this is the correlation to it, weeks of inventory right here. We were at the absolute peak, we were at about 2.1 weeks of inventory. That is absolutely insane. A balanced market is anywhere from 4 to 6 months worth of inventory. 2 weeks of inventory, about 0.5 months, is ridiculously low. That means that if we didn't take another listing at the current absorption rate in January of 2022, if we didn't take another listing, it would take 2 weeks to fully absorb all of that inventory. Every single listing would sell in 2 weeks. Again, just a metric that we use, but looking at that supply and demand, again, if you find this nerdy, I apologize, but it explains everything so well and how we were able to predict this and kind of what's happening. We're looking at active listings to the amount of solds. So if you're noticing this, we saw pretty steady sold numbers each and every week. We're actually starting to see that go down a bit now, but what are you seeing here? The number of active listings, that difference between active listings and sold is that more and more listings are coming online, but the same amount, if not less, are being sold. So what is that creating? That's creating exactly what we see over here in the weeks of inventory. As the amount of listings continue to rise, people trying to jump into the market, you're seeing much more competition now in terms of listings. With the sales going down a little bit, we're seeing weeks of inventory spike. And what are we seeing? We are seeing the prices on that trend line right now going down. Again, understanding where you're at, there's always opportunities in every single market. People might say, oh, but the prices are going down. If you're buying in that market, is it a bad thing? It's a great opportunity for people that are buying up. It's a good opportunity for investors. People say, well, I'm going to wait till the market hits the bottom. I always ask people, when will that be? Because if you could tell me that, let me know. We could all make a whole bunch of money together by investing when you have your crystal ball tells you that it's going to be the lowest point of the market. Again, whether you're selling or buying, if it makes sense and you're holding long term, if you have a plan in place, there is always opportunity. But again, looking at this, it's pretty drastic when you can see what has actually happened. And so when we were talking and guiding people through these times, it's tough for the general public that doesn't see this stuff every single day to kind of wrap their heads around it, but this is exactly what's happening. The last one I'll show you is Burlington, very much the same. Niagara has been it was like what we just saw above, except on another level. In Niagara, we have almost 2,000 listings. And if you can see, the amount of solds have gone down quite a bit. the amount of listings that are active have, I mean, it's just a continued inventory, again, the supply curve compared to the demand. We're seeing that delta right here is having downwards pressure. And if you see where we've been and where we're going to, that downwards pressure is definitely coming to play with the supply and demand plus the interest rates as well. So there's a lot of factors going in there. We can get into much more deeper detail. I would love any feedback if you have it. If you've taken the time to watch this whole video, congratulations, you're a huge nerd like me and you want to understand what's going on. But really having the finger on the pulse of the market, which we do, understanding from a mortgage broker where you stand, and really working on a plan. There's always opportunity. And if it means holding off right now and not doing anything, at least get the right information so you can do so. If you'd like to talk to me more, give me a call anytime, 905-515-1276. And hope you guys do well. Cheers.